Ladies and gentlemen, it's my pleasure to welcome you all back to Talking Numbers Investment Plus. It's our new podcast series, a part of the Talking Numbers podcast series where a few weeks ago we brought you Talking Numbers Property Plus, and today we are bringing you Talking Numbers Investment Plus. If you're joining us for the first time and you've maybe missed the first two episodes, my name is Paul Jantz. You've got the ability to go back, check out our first episode, which was on retirement. Our second episode, we spoke about self-managed super funds. And today, before we get into that, we're going to talk about asset protection and assets and so on. But we're brought to you by Virtual Financial, which is making financial advice affordable to all Australians. I have their CEO and founder, Adem Becirevic. Adam, welcome back to Investment Plus, our podcast series. How are you, mate?
Excellent, Paul. Thanks, mate.
That's good. Good to have you back. How's things up in Brisbane?
Lovely. Weather's beautiful. Very nice.
Yes. We've got a bit of a rainy day here, although we are in spring, and the outlooks is always good. As you get into September, it's always going to get closer to summer. So being in Melbourne, it's always good to get out of the cold. Mate, before we get into episode 3, you okay to take us through, I sort of mentioned it before, your tagline for the company. I know it's a really important one, and the market are really responding and resonating really well with that. Are you okay to take us through that, just to give everyone, all of our listeners, a little bit more, why you chose that?
Yeah, look, at the end of the day, I suppose my background is I started as an accountant. I came from a family that did it pretty tough back in Melbourne. Grew up the hard way, so I've always been that. I suppose that sort of person that's always wanted to help people. That's why I got into financial advice. And what I've seen in the industry, what's happened with the government, with the Royal Commission, everything else, it's really making it difficult for people to get financial advice. So what I want to try and do is make financial advice affordable for all Australians. And so we're really trying hard to do these events, do the webinars, the podcasts, give our clients and other people information to try and help them along the way, because we believe financial advice is really important and it makes a massive difference.
Yeah, well said. And I couldn't agree more. And I think that's the number one deterrent. I think the fact is that it becomes quite costly. So you look at the way, whether it's interest rates rising, whether it's cost of living, whether it's petrol, the excise is about to get dropped off. So therefore, petrol's going to go probably up to $2.30, $2.40 again.
Yeah.
These are all the things that stop people from getting the right advice, because it's sometimes out of reach. And you go, well, if I need to cut something out because I need to put food on the table, I probably won't get the financial advice. But having said that, you've built a fantastic model that provides all Australians with the ability to get financial advice.
Yeah, exactly. It's very important.
Brilliant. Mate, we spoke about retirement, the importance of having assets, income. Then we went through the self-managed super fund as a really good option to maybe an industry fund or a retail fund. Let's get into assets. Let's get into, obviously, whether it's our, the number one asset's probably our family home. We all love to buy our family home. I mentioned in the last episode about, with my 3 boys, and I did it with my dad from a very young age. We play a lot of Monopoly, so therefore we're already thinking about property. And I think that's the great thing that it allows my boys to think about is property. But when we've got our assets, tell me why we would protect them to start off with.
Yeah, look, it's very important. I think, you see all the time on the internet, on Facebook, GoFundMe pages. And it's really sad, because, as you said, people, not everyone, but most people buy property and have a home. But normally on the other side of the equation, they also have a debt. And, 12% of bankruptcies are from people getting sick or dying where they can't afford to keep paying for their asset. And there's nothing worse than if you're married or whatever and you've got kids, and we've seen it a number of occasions I've seen a number of occasions with my friends and family and so forth, where they've had wife and kids and unfortunately passed away and left debts and no income and made life really, really terrible for the other party. So, for a cup of coffee a day, you can probably cover all of that in regards to life cover. So just taking out one would give you enough money to probably pay out your home loan. I'm not sure why people wouldn't do that. And plus, you can also have it paid for through your super. So protecting your assets and protecting what you have, and for a day, no one likes to think about dying or getting sick or getting cancer or having a heart attack, but I can assure you it happens all the time. And if you don't believe me, just go for a walk to the hospital.
Yeah, it's very true, very true. And I think sometimes people forget about that. The fact is, yeah, we might own a $2 million home, but we might have $1 million debt. And I think in that instant that you just said, then it sort of resonated very much with me to say, well, so you're saying that you can cover yourself, or all of us can cover ourselves, that in case of death, that debt is paid out.
Correct. Yeah. The debt should be cleared by the person that created it. So if something happens to them, they should be able to clear that debt. And, we've seen it firsthand with clients where we have looked after our clients, where their clients have got advice, 1 in 10 that got advice, where, the husband's unfortunately died, and we've handed over a check for $2 million, where, it's given the wife, she's able to bring up the kids, have no debts, send the kids to private schools, and still have a life, even though obviously she's lost her husband, which is terrible. And obviously we can't do anything about the emotional side, but at least from the I suppose the financial side, you don't want to have two problems. You don't want to have the emotional side and the financial side. That's real chaos. You really want to be in a position where you only have, the emotional side, and obviously the financial side's all looked up. We've had a number of clients, where this has happened to, and where we've paid out millions of dollars. So the companies pay out, like once you've got a death certificate, they just basically the following day the money's in your bank account.
Wow. Okay. And look, that's probably a really big one, isn't it? Because you just said then the emotional stress that you'd be going through at that time, you want to make sure that there's not another stress that's involved when the bank comes knocking on the door, that you've got actual insurances to cover that.
Yeah, I've seen it, a dozen times where it's made a massive difference to people's lives.
I can imagine.
So it does it, and I still can't understand why, more people don't have. Again, I think it comes back to what I said in one of the other episodes, is taking that one day a year to make sure your financial affairs are in order. And one of those should be, even if you are with an industry fund or whatever it might be, you need to ask the question, do I have enough money to pay all the debts if something happened to me? Is my wife or is my husband going to be looked after? So it gets back to that one day a year where, if you don't see an advisor, you've got to be held responsible. Our strapline is, it starts with you. So, it starts with you. You've got to make an effort.
What a great piece of advice that is. So if you missed our previous episodes, one of the things that Adam and I spoke about was the ability to take some time out, whether you're doing that with your partner, your husband, wife, whatever it may be, and whether it's half a day or a full day, and go and assess all the things that you want to plan for in the future and tick the boxes, I suppose. On Adam's website, he has the ability for a 5-minute, it's a complimentary 5-minute health check. And I'm pretty sure it covers things like this as well, doesn't it, Adam?
Yeah, it certainly does. It goes through all the insurance questions. So it gives you a rating on how, on a scale of, 1 to 10, how you're going for your insurances. Are you on track, or do you need some help?
Okay, so it's important that, some of the key things that we just spoke about then was, again, taking that time to look at that, do it together. The 5-minute health check is probably one of the most important things you can do, and do it annually. Do it half yearly if you want to, because it gives you a trigger. What I like doing is, and we spoke about this in the previous episodes, is do it annually. The great part of what we've got is we've got the start of a calendar year and we've got the start of a financial year. Okay, so they should be 2 trigger points. Typically, they could be 2 holiday times as well. Just stop and start assessing all of those key things in your life, and I'll guarantee you they bring clarity to what you should be thinking about as well. And I think that's one of the great things. Mate, let's talk about again, we spoke about the protecting of the assets, the 5-minute health checks, the other insurances that come into play. Look, I see this as I'll call it risk management, and how we can also, Because if something happens to me, I also want to secure the future for my children, my three boys. That's something that people need to think about, isn't it?
No, it certainly is, mate. Yeah, that certainly is.
And that's where, again, on the flip side, let's talk about, because we've given all of our listeners a good idea of maybe what to do, and obviously covering that debt. On the flip side, what happens if you're not protected? What could happen?
Yeah, well, Paul, as I said before, I mean, 12% of bankruptcies come from people not being able to pay their mortgage because of sickness, right? So, obviously you could lose your home. It's going to affect your retirement
12%.
savings. It's going to protect your retirement savings. So obviously, if you can't work for a couple of years, it's going to make a big dent in regards to what you're going to have in super. So it does make a big, like income protection, for example, is tax deductible. It can also be paid for through super, but if you pay for it yourself, it's tax deductible, and that's going to protect your income for to age 65 if you get the right cover. And having trauma cover in place, which is a cover we used for that protects against cancer, heart attack, and stroke, gives you a lump sum, and then obviously having the life and TPD in place for your super. So it's really important, So if you don't have those insurances in place, and something happens and you get sick, well, obviously, basically you're self-insured. So you're self-insured. You then need to go to family and friends and ask for money and go to the banks and ask them to defer your payments. And I have unfortunately seen this happen to people, and it's not pretty when someone dies. They just leave nothing behind. It's and I've seen it where people have actually physically cancelled their insurances because they didn't want to pay $800 a year, but now they're not here. It's costing their family. It really just about ruins a family. So
Yeah, I can imagine.
having insurance in place is just so important. I mean, insurance companies pay out billions of dollars a year. Billions. I know there's kind of a myth around that people think that insurance companies don't pay, but it's totally untrue. If you've got the definition of whatever's happened, you will get paid. I mean, the death one's easy. Death certificate, they pay you. And income cover, as long as you get a letter from your doctor to say, hey, you can't work, you'll be covered. So insurance companies pay out billions and billions of dollars, a year. And, and there's a reason for that. People are getting sick.
Yeah, that's exactly right.
And what really interests me too is for all listeners is that the insurance companies that we use, not all, but the insurance companies we use, all protect against coronavirus. So, if you died during coronavirus or couldn't work for 6 or 12 months, you would have been covered under our policies.
Interesting. Okay.
Yeah, it is interesting. Yeah.
Absolutely. Well, this is the thing, I suppose. Whether it's coronavirus, it's led to even, whether it's, and I know our unemployment rate is an all-time low. So work, but if you're sick and you can't work, well, then you've got challenges. So you spoke about income protection before. So let's maybe take a deeper dive into that, because I've got a lot of friends that are, they're around that 35, 40 mark, and they probably think that they're Superman, Iron Man, and yeah, that's right. They're bulletproof, and they, we often have these interesting discussions, whether it be around wills, and I know we'll talk about that soon as well. But we also talk about income protection, because no one knew COVID-19 was going to hit us. No one knew. No one still knows the after effects of any of that. So, a 40-year-old, why would I look to have income protection is the question that I get asked a lot. And it's like, interesting. What's your answer to that?
Well, first of all, I think it's really interesting that if you followed the Royal Commission under the insurances, is that insurance companies were losing up to $2 to $3 billion a year paying out income protection insurances. So it's not like no one's not getting paid. There's not like no one's getting sick. And as we know, you could be bulletproof, but we had a client who had insurances with us, and 6'2", 90 kilos, 40-year-old, ex-rugby player, strong as an ox, and anyway, had to go to hospital, have 3 stents put in his heart. So he thought it was bulletproof as well, but luckily we had some insurance for him, so we were able to help him. But heart attacks, cancer, strokes, all these sort of things. Unfortunately, sometimes it doesn't matter, or any other disease for that matter. It doesn't matter. It doesn't matter how well you look after yourself. Obviously, it definitely helps. I exercise myself and run, and I ran my first marathon this year. But to try and stay healthy. But there's no guarantee.
No, there is.
And I think for someone that's 40, what I say to clients is, if you could just pay 1 or 2% of your wage and know that you're always going to receive that wage till 65, would you do it? And they normally say, yeah, I probably would, and it's tax deductible. That's all it costs. It's a couple of percent of your wage to protect your income for the rest of your life. Now, if you're only 40 years old, and let's just say you're $100,000 a year, you cover to age 65. Well, that's 25 years. That's without indexation. That's $2.5 million. So at the moment, that guy who's bulletproof is risking $2.5 million. If you include indexation, it's probably about $4 million. He's risking $4 million hoping that he doesn't get sick. So if he did get sick tomorrow and he couldn't work for the rest of his life, he's just thrown $4 million down the gurgler. Whereas if he had the insurance in place, or what I say to clients when we do the plan for them, we do the retirement plan, which we spoke about in the other episode. The only thing that's going to stop this is if we're not going to achieve this is if we don't have income coming in. So we need to protect the income. So protect the income, we know that your retirement goals are always going to be achieved.
Otherwise, it's counterproductive, isn't it?
Yeah. So why people don't have income protection in place is beyond me. Yeah.
And does it typically cover the full wage?
No. So it covers. There's been changes to income protection at the moment. So because I've been losing so much money, they've made some changes to it. But it's still a good policy. So it covers up to 70% of your salary.
Okay. Yep.
So it's still beneficial, and as I said, it's still tax deductible if you pay for it yourself. So it's not going to cover all your wage, but it'll cover a good chunk of your wage anyway.
So if you're on $100,000 a year, it'll cover $70,000.
Correct. Yeah. And then you can also top it up for super as well for some of the companies. So then you get another 10%. So really you can cover 80,000 really. So that's one of the things we do for our clients as well. So yeah, really important. I think that's the number one thing I say to our clients is, income covers the number one thing you should have in place. Then the second thing would be life cover to make sure your debts are paid out.
Yep. No, it's a good point. And it's as a part of that, just to carry on that conversation where I'm with friends, I suppose, I always ask them, do you own a car? It's like, yeah. Well, do you have car insurance? Yes. Do you own a home? Yes. Do you have home insurance? Yes. So they're ticking boxes there. Well, if you've got assets, why aren't you protecting the most important assets to protect your family?
Well, Paul, it's funny, Commonwealth Bank actually did a survey on this a few years back, and I haven't got the exact stat in front of me, but basically car insurance, on average, the average car claim is $5,000. So you're paying all that car insurance, and on average, you only get to pay out of $5,000. Income protection, as we just said before, your payout could be 2.5 million. So, people won't revert. It amazes me. People won't reverse out of their driveway without car insurance, which theoretically is only going to save them $5,000. However, they'll reverse out of their driveway knowing they've got no income cover and they might risk $4 million. So it doesn't make sense. And that's what the Commonwealth Bank come up with. CommonSure, they had the same theory.
Yes.
They can't understand how people will go out of their way to have car insurance, which might protect them $5,000, whereas income cover they don't care about, and it could cost them anywhere between $1 and $4 million.
Phenomenal statistics. And then look, that's the reason why that I suppose we're actually chatting about this to educate people, to say,
that's right,
go and have a look at this, go and have a look at that, and more importantly, go and do the 5-minute health check on the Virtual Financial website. Click on that, run through it. It takes 5 minutes, and you know what? Then it might show you some areas of deficiency that need the advice to top up, and that's the great part about it. Mate, as we look to wrap up this particular episode number 3, as we talk about protecting our assets, final piece of advice. What do you think before we go into our next episode? What's your final piece of advice on this?
Oh, look, I think the most important bit of advice I can give is to, again, take that one day off, make sure you've got the right insurances in place, do the 5-minute questionnaire, and just find out exactly what you need. I mean, the number one thing you've got to have is income cover. If you don't have income cover, whether you do it through Virtual Financial or you do it through an insurance company, just go and get it done. Bring up your industry fund or whoever it might be, and just get the income cover in place. Because one interesting thing is that the industry funds don't necessarily just offer you that income cover, or they have restricted kind of cover where it only goes for 2 years rather than to age 65. So find out what they've got, but you're better off having something in place rather than nothing.
True. So the idea is have income protection in place, and we spoke about this when we were talking about retirement in our first episode, which was, retirement is till 65. I think you mentioned till 67. So you can have your income protection running while you're working to protect that income, and all those statistics that Adam just mentioned. This is the beauty of this particular podcast. Yes, it's here to educate. Yes, it's free advice, but go back, because I think there's so many valid points that Adam has shared over the last 25 minutes. It's just critical to actually go back and go, right, did I know that? Did I not know that? I'll write that down. Let me chat to my financial advisor. If I don't have a financial advisor, go and jump on the Virtual Financial, the Virtual Financial website, do the 5-minute health check in with Adam if you want to, and just have a chat to him. And that's the great part about what this is about. It's about education. And we're hopefully educating all of you to take the proactive steps as opposed to the reactive and do nothing. And then you could find yourself and your family in a lot of trouble down the track. So, mate, just a brilliant piece of advice, and thank you. Before I let you go, what are we talking about next? Episode 4?
Episode 4, we're going to be talking about superannuation, different super funds.
Good. It's something that we all have. It's something that our employers, as a part of our as a part of working, we just spoke about our income as a part of our salary package. We all get allocated. I think it's just gone to, is it 10.5%?
Yes, mate, 10.5.
Beautiful. So we've just gone from, I think it's increased from the 7s to the 8s to the 9s to the 10s, and now it's 10.5% from 1 July. So we're going to talk about that, and we're going to go into a little bit more detail about the options available to you. So that's going to be good. Adam, thank you again for joining me today. It's, again, our new exciting Talking Numbers Investment Plus series. It's our educational series of Talking Numbers that continues to provide all you guys out there listening to this just education, content, and hopefully it brings continued value, which is really, really important from us to you. So thanks for joining us, and we hope you enjoy the rest of your day. Look out for our next episode of Talking Numbers Investment Plus. Thanks, Adam.
Thanks, mate.